So let's talk about the Lifetime Capital Gains Exemption. The Lifetime Capital Gains Exemption presents a significant tax planning opportunity for incorporated small business owners in Canada. A small business owner like yourself could sell shares of a qualifying small business corporation for proceeds of up to $913,630 in 2022 and reduce or completely eliminate the personal income taxes that you would realize that would normally be taxed as capital gains on such a sale. To qualify for the Lifetime Capital Gains Exemption, the shares of the corporation itself, needs to meet three tests. And so for 24 months leading up to the sale of the qualifying small business corporation shares, you need to own those shares. And this rule prevents people from buying shares of a corporation and then immediately selling those shares to be able to claim the Lifetime Capital Gains Exemption, basically buying and swapping for tax purposes. And so you have a requirement to purchase, hold, maintain those shares for 24 months before selling them to be able to claim Lifetime Capital Gains Exemption on your personal tax return when you eventually sell. The second test is, I call this the 90% requirement. The 90% requirement requires that at the time of a sale, 90% or more of the assets of the business need to be used in earning active business income. And so that means like cash and equipment, things that like you're using to generate revenue from your company. And so when we talk about like active assets, we're talking about things that like you're using to generate business income. And so the opposite of that would be passive assets, things that you hold as investments that maybe generate revenue, but they don't form part of your active business. Would be things like investment portfolios or like rental properties, things that you own as property that provide you a return on investment but aren't used in earning active business income. And so at the time of the sale, 90% of the assets in your business need to be used in earning active business income. The third requirement is the 50% requirement, and it requires that for the 24 months leading up to the sale of shares of a corporation, that 50% or more of the assets of that corporation be used in earning active business income. And so the same way with the 90% test, like it needed to be assets that are used in earning business income. For 2 years leading up to the sale, 24 months, 50% or more of the assets need to be used in earning active business income. It means that you can't have investment portfolios or rental properties or like revenue generating like investment assets inside of this corporation to the extent that it's more than half of the value of the corporation. So, and those are important rules because like if you qualify for those rules, you qualify for the Lifetime Capital Gains Exemption when you sell your shares. If you don't like meet those three tests, then you don't qualify for the Lifetime Capital Gains Exemption, and the sale of those shares becomes a taxable transaction for you. Where we often see people get offside with the Lifetime Capital Gains Exemption is that like businesses that get sold are typically profitable businesses that generate like revenue and profits and accumulate cash, and then that cash gets turned into investments. And without the benefit of proper planning, people will sometimes hold those non-active assets inside of their operating corporation, putting themselves offside for the Lifetime Capital Gains Exemption. And so some mistakes that you want to avoid would be holding an investment portfolio in your active business corporation. That's going to put you offside for the Lifetime Capital Gains Exemption. It's also poor planning in terms of like liability protection or creditor protection, like when it comes to those investment assets. Having rental properties inside of your operating company, if you're not using like 50% or more of a rental property like for like running your active business, that would typically be classified as a passive asset, and it could potentially have the effect of putting you offside for the Lifetime Capital Gains Exemption. And then one that people don't often think about is there's this concept, it's called redundant cash, where like a corporation might not have an investment portfolio or revenue generating assets, but it just might have too much cash on the balance sheet. And Canada Revenue Agency actually has the power and sometimes the desire to look at redundant cash and say, you've got too much cash, this is a passive asset, you no longer qualify for the Lifetime Capital Gains Exemption. And so with with proper planning, you can avoid like some of these pitfalls. Sometimes like what we recommend clients do is either take things like investment portfolios or redundant cash and convert them into active like revenue generating assets, whether that be buying equipment to be able to run and grow your business, or buying a building like for your business to be able to occupy. Another opportunity to plan is to get those assets out of that corporation and reposition them into an investment company or a holding company that's completely independent from your operating company. That puts you in a position where you could potentially sell your operating company, qualify for the Lifetime Capital Gains Exemption, but still have your investment assets positioned in a separate independent corporation. I think the most important part is to work with a tax accountant like at McLennan and Associates to be able to plan for the Lifetime Capital Gains Exemption and to make sure that you qualify. It's typically the kind of thing that you want to be thinking about a few years before you're going to sell your business, because sometimes what we see is that a person isn't anticipating the Lifetime Capital Gains Exemption or even just like anticipating the sale of their business. And then an offer comes along and an opportunity for that person to be able to realize a non-taxable sale, but because of a lack of planning and they just haven't had those conversations with our accountants, the result is that they might not be eligible and they might need to defer that sale or complete that sale but under a taxable transaction. And so it's important to know about, it's important to think about. If you're anticipating that you're going to sell your business, it's important to have a conversation, likely like 2 years or more before that eventual sale is going to take place, so that you know the rules and can be working to make sure that you are basically meeting that framework, those 3 tests that are required for you to qualify for the Lifetime Capital Gains Exemption. If you have questions about the Lifetime Capital Gains Exemption, feel free to reach out to me. You can send me an email at success@mcclenahan.com. I'd be happy to answer any questions that you have or clarify anything that you need to know about the Lifetime Capital Gains Exemption. Thanks for watching. Have a great week, and we'll talk soon.